Right now, at this very moment, there are two prices for silver. One price is real, one price is fake. And if you do not understand the difference in the next 20 minutes, you could lose everything or miss the greatest wealth transfer of our lifetime. Across the globe, silver is experiencing a phenomenon that has never been seen at this scale. In the UAE, physical silver trades at $170 per ounce. In Japan, buyers are paying $150 per ounce. In China, it is $140. Meanwhile, paper silver, the kind you see on COMEX in New York or on financial websites, remains far lower, giving a misleading impression of the market. This isn't just a gap, it's a warning. It's a signal that the financial system is being tested in ways most people cannot even imagine. And in just a few moments, we'll reveal why this gap may never close and why the consequences could reshape the global silver market forever. Now, we'll explore the shocking divide between physical and paper silver. Physical silver bars, coins, and allocated inventory represents ownership of actual metal. Paper silver, in contrast, consists of futures contracts and ETFs, promises that may or may not be backed by real silver. This discrepancy has never been more pronounced. Across continents, physical silver is trading at premiums as high as 60 to 70% above paper prices. Investors are paying massive amounts just to secure metal they can hold, store, or trade. It's a stark reminder that numbers on a screen do not always reflect reality. Consider this. A single ounce of silver can cost $13 on paper exchanges, but $170 physically in the UAE. That's a difference of over 1,200%. In relative terms, when looking at actual purchasing power and ownership, we'll uncover why the paper-silver system is starting to break and why those holding only contracts might be left empty-handed. Further, let's examine why paper-silver is so different from physical silver. Exchanges like COMEX trade contracts, not metal. For every ounce of silver in the vault, hundreds of paper ounces are circulating. This leverage allows speculative trading to flourish but depends entirely on participants not demanding actual delivery. When demand for real silver spikes, the system begins to strain. In the first 2 weeks of January, over 33 million ounces of silver were physically withdrawn from COMEX vaults, 26% of their registered inventory in just 7 trading days. People no longer trust paper. They want real metal. Right now, the system is struggling to keep up. Now, we will explore how these withdrawals are creating a global shortage and why the free float of silver is far smaller than most investors realize. Let's talk on the global supply situation. COMEX's registered silver inventory may seem high, but much of it is already allocated. Analysts estimate that the free float, the silver you could actually buy and take delivery of, is less than 100 million ounces. Global demand, meanwhile, exceeded 1.24 billion ounces last year. That is a 230 million ounce deficit in a single year. What does this mean? The silver that remains in vaults is either spoken for or inaccessible. The window to acquire physical silver at reasonable premiums is rapidly closing. This isn't just theory. These numbers represent a real, tangible scarcity that is influencing prices worldwide. Further, we'll examine China's dominant role and why their recent policy changes are reshaping the global silver market. Now, we will explore China's influence. China refines approximately 65 to 70% of all silver produced worldwide. Every major mine in Mexico, Peru, and Australia sends ore to China for processing. On January 1, 2026, China reclassified silver as a strategic material, allowing only 44 approved companies to export, each meeting strict production and credit criteria. At the same time, domestic buyers in China are panic buying silver, driving premiums $8, $15 above international prices. The government is prioritizing domestic supply and restricting exports. The result? Physical silver is increasingly concentrated in China, leaving the rest of the world competing for a shrinking pool. Next, we'll see why physical silver is outperforming paper silver and why major banks are scrambling to stockpile real metal. Further, let's examine the growing divide between physical and paper silver. Normally, arbitrage would close price gaps, buy low in one market, sell high in another. But that's not happening. Banks like JP Morgan are aggressively taking delivery of physical silver, while others struggle to find any. Retail buyers in Japan, UAE, and India are paying unprecedented premiums just to secure metal. It demonstrates a critical point. Physical silver is now more valuable than paper promises. Those holding only contracts or ETFs are at risk if delivery systems fail. The market is showing a clear preference for real, tangible assets. Next, we'll explore how industrial demand and global retail frenzy are pushing prices higher and why this could continue for years. Now, we will explore how industrial and retail demand are shaping silver prices. Every solar panel, electric vehicle, AI server, and 5G installation requires silver. Demand from technology and infrastructure is inelastic. Companies need silver regardless of price. Retail buyers are also contributing. In Japan, UAE, and India, consumers are paying 60 to 70% premiums above paper prices. Supply is constrained, as 70% of silver comes as a byproduct of other mining operations. Opening new mines takes 7 to 10 years. With production slow and demand rising, physical silver prices are unlikely to retreat anytime soon. Let's examine what could happen next in the markets and why owning physical silver may be the safest move right now. Further, let's examine potential scenarios for silver. Spot prices now often exceed futures prices, a situation called backwardation. Lease rates for borrowing physical silver have surged to 35% annually at peak times. Registered silver inventories are shrinking, eligible silver remains locked, and central banks are quietly accumulating physical metal. The implications are clear. Either paper silver prices will rise to meet reality, or the system could fail, leaving only physical silver as true value. Historical data, global supply constraints, and industrial demand all point towards significant upside potential. Which outcome do you think is more likely? Paper silver catching up, or the system breaking completely? Comment below. I want to hear your thoughts. Finally, let's summarize. Physical silver is surging in the UAE, Japan, and China. Paper silver cannot keep pace. Industrial consumption, global shortages, and strategic accumulation are driving premiums ever higher. If you are considering investment, focus on verified, allocated physical silver from reputable dealers. Avoid paper promises when possible. The forces driving this market: supply deficits, industrial demand, and geopolitical strategy will continue for years, creating one of the most asymmetric opportunities in modern financial history. Subscribe to the channel, like this video, and comment your thoughts. Turn on notifications so you don't miss updates, because what's happening now could change everything. The window may not stay open for long.